I need you to turn off the television. I need you to close the other browser tabs, even the adults' websites. I need you to listen to me very carefully because what I am about to tell you is not speculation. It is not a prediction. It is not a theory. It has already happened. Ladies and gentlemen, Asian guy here. The event that we have been warning about for years, the event that the mainstream financial media told you was impossible, the event that the bullion banks swore could never occur, just occurred. And it happened while you were sleeping. It happened while the Western world was distracted by headlines about Iran. It happened on Thursday night, January 9th, 2026. The Shanghai Gold Exchange failed to deliver physical silver. Not failed in the sense of a small delay. Not failed in the sense of a technical glitch. Failed in the sense that 98.5% of the metal that was requested simply did not exist. Failed in the sense that the vault doors opened and there was nothing inside. Failed in the sense that the paper promises were exposed as lies. Let me give you the numbers because numbers don't lie. Politicians lie, bankers lie, the media lies. But mathematics is truth. On Thursday, January 9th, the Shanghai Gold Exchange received delivery requests for 64 tons of physical silver. 64 tons. That's not a small amount. But it's also not extraordinary for the world's largest physical silver exchange. In a functioning market, that request should have been filled without breaking a sweat. Do you know how much silver was actually delivered? 1 ton. 1 ton out of 64 tons requested. That is a failure rate of 98.44%. Let me say that differently so it sinks in. For every 100 ounces of silver that holders demanded, they received 1.560. The other 98.44 gone, vanished, non-existent. This is not a squeeze. This is not a shortage. This is a default. This is a force majeure event that they simply haven't labeled as such yet. Because the moment they officially declare force majeure, the entire global silver market implodes. So instead, they are pretending it's a logistical delay or a settlement issue. They are buying time. They are hoping you don't notice, but we notice. And now you know. Let's put this in perspective so you understand the magnitude of what just happened. 64 tons equals approximately 258,000 troy ounces. That's the amount that was requested. 1 ton equals approximately 32,150 troy ounces. That's what was delivered. So we are talking about a delivery of 32,000 ounces against a demand of 2 million ounces. Now compare that to the COMEX. The COMEX registered inventory, the metal that is supposed to be available for immediate delivery, sits at roughly 30 million ounces as of this month. That sounds like a lot until you realize that the open interest in COMEX silver futures represents hundreds of millions of ounces of paper claims. But here's the kicker. If Shanghai, with all of China's refining capacity, with all of China's domestic production, cannot deliver 64 tons, if they can only scrape together 1 ton, what makes you think the COMEX can deliver when the squeeze hits New York? The answer is, they can't. And deep down, they know they can't. So, let's talk about what this delivery failure actually means. Because this is the moment that the bifurcation we have been discussing for months becomes permanent and irreversible. For decades, the global silver market has operated on a lie. The lie is this: paper silver and physical silver are the same thing. You could buy a futures contract in New York for $75 an ounce, or you could buy a physical bar in Shanghai for $75 an ounce. The market assumed these were equivalent. If they ever diverged, arbitrage traders would step in and close the gap. But on January 1st, 2026, China implemented the export licensing system. That system made it nearly impossible to move silver out of China. The arbitrage bridge was blown up. The two markets started to drift apart. By late December, Shanghai was trading at $89 while New York was at $75, a $14 spread. We talked about this in previous videos. We said the spread was unsustainable. We said something had to break. Well, it broke. And what broke was the physical market in China. Why did it break? Because of what we call the war economy drain. You see, the reason Shanghai couldn't deliver 64 tons isn't because China ran out of silver. China is the world's largest refiner. They process more silver than any other nation on Earth. So where did the metal go? It went into the vaults of the Chinese military and the Chinese government. Because we are now living in the early stages of a global resource war. And silver is not just a precious metal, it is a strategic war material. Let me connect the dots for you because the mainstream media is reporting these stories as separate events, but they are all part of the same picture. Story number 1, Iran. As of this weekend, the protests in Iran have escalated to the point where the government has shut down the internet in multiple cities. There are reports of violent clashes in Tehran. President Trump has issued statements suggesting that the United States is considering intervention options if the Iranian regime collapses into chaos. The geopolitical analysts are openly discussing the possibility of a military confrontation in the Persian Gulf within the next 30 to 60 days. Story number 2, Venezuela. The United States government has announced that it is moving to unlock and liquidate between 30 million and 50 million barrels of Venezuelan crude oil that have been held in strategic reserves or under sanction-related seizures. The official story is that this oil will be sold on the open market to stabilize prices. But the real story is that the U.S. government needs cash. They need funding. Funding for what? Funding for the war machine. Now let me ask you a question. What does a modern military need to function? It needs steel, it needs oil, it needs lithium for batteries, and it needs silver. Silver is in every missile guidance system. Silver is in every radar array. Silver is in every advanced electronics package on a fighter jet or a naval destroyer. The Patriot missile defense system that the U.S. is deploying across the Middle East. Each unit contains significant amounts of silver for its targeting and tracking systems. The Chinese DF-26 carrier killer missile, same story. The Russian hypersonic systems, same story. When nations prepare for war, they hoard the metals they need to build weapons. And right now, both the United States and China are hoarding silver. That's why it's disappearing from the exchanges. That's why Shanghai couldn't deliver 64 tons. The metal isn't sitting in a warehouse waiting for speculators. It's sitting in a military depot in Jiangsu province or in a defense contractor's vault in Nevada. This is what I call Stage 4 of empire collapse. Stage 1 is financialization. The economy shifts from making things to trading paper. Stage 2 is debt accumulation. The government borrows to maintain the illusion of prosperity. Stage 3 is currency debasement. The central bank prints money to service the debt. Stage 4 is war economy. The nation shifts all resources toward military dominance in a desperate attempt to preserve global power. We are in Stage 4 right now. And in Stage 4, commodities disappear from civilian markets because the government needs them for military purposes. So when I tell you that Shanghai failed to deliver 64 tons, I'm not just telling you about a market failure. I'm telling you about a geopolitical realignment. I'm telling you that the age of cheap silver is over because silver is no longer treated as a commodity. It is now treated as ammunition. And this brings us to the question that everyone watching this video wants answered. What happens to the price when the world realizes that the physical metal is gone? Well, the mainstream analysts are finally catching up to what we've been saying, and even they are starting to panic. I've been reading the reports from Live Mint, from MCX, from the Indian commodity analysts, and they are all saying the same thing. Monday, January 13th, 2026, is going to be a historic day for silver prices. The technical analysts are predicting an immediate gap up at the Asian Open. They are saying we could see silver open somewhere between $82 and $85 per ounce. Not drift up, not climb slowly, gap up, meaning the price will teleport from wherever it closed on Friday straight to $82 or $85 in the first minute of trading. In India, where silver is traded on the MCX exchange in rupees per kilogram, the analysts are predicting a breakout above 253,000 rupees per kilogram, with a fast target of 260,000 rupees. For context, silver has never traded at those levels in India before. This would be an all-time high by a significant margin. Why are they so confident? Because of the Shanghai failure. The delivery failure is not a secret in Asia. The traders in Mumbai and Singapore know exactly what happened on Thursday, and they are front-running the panic. They are buying physical metal this weekend at any price because they know that on Monday morning, when the rest of the world wakes up and sees the delivery data, the buying pressure will be overwhelming. But it's not just the gap up that we need to prepare for, it's what comes after the gap up. Because if Shanghai cannot deliver, the arbitrage between East and West is permanently broken, and that means the paper price in New York becomes completely irrelevant. Think about the mechanics here. If you are a large industrial buyer, let's say you're Samsung, and you need 10 million ounces of silver for your electronics production in the first quarter of 2026, where do you source that metal? Traditionally, you would call your broker in London or New York. You would buy a futures contract on the COMEX at the spot price. You would stand for delivery. You would take the bars out of the JP Morgan vault and ship them to your factory. Easy, efficient. But what happens when the futures contract doesn't deliver? What happens when you stand for delivery and the exchange says, "Sorry, we don't have the metal. Here's a cash settlement instead." You can't build a smartphone with cash. You can't build a solar panel with a check. You need the physical metal. So, where do you go? You go to the physical dealers. You go to the refineries, you go to the private vaults, and you offer to pay whatever price is necessary to secure the metal. And those dealers look at you and say, the spot price might be $78, but we are selling physical at $95. Take it or leave it. And you take it because you have no choice. This is the physical premium explosion that we have been warning about, and it's already starting. If you try to buy physical silver right now, if you call a dealer in the United States or Europe and try to buy a monster box of American Silver Eagles or a tube of Maple Leafs, you're going to pay a massive premium over spot. Not $2, not $5. We are talking about $10, $15, maybe even $20 per ounce premium. Why? Because the dealers know what's coming. They know that on Monday morning the demand is going to explode and they don't want to sell their inventory cheap. So, they are raising prices preemptively. This creates a two-tier market. On one tier you have the paper market, the COMEX futures, the ETFs like SLV and PSLV, where the price is still in the $70 to $80 range. On the other tier, you have the physical market, the coins, the bars, the allocated storage, where the price is already pushing $90 to $100. And here's the terrifying part. The gap between these two tiers is only going to widen because every day that passes, more people are going to realize that paper silver is worthless. They're going to try to redeem their ETF shares for physical metal. They're going to try to take delivery on their futures contracts, and they are going to discover that the metal doesn't exist. This is the bank run on silver. And just like a bank run on a regular bank, the first people through the door get their money. The last people through the door get nothing. So, let's talk about the ETFs, because if you own shares of SLV or any other silver ETF, you need to understand the risk you are facing right now. The largest silver ETF is the iShares Silver Trust, ticker symbol SLV. It holds approximately 500 million ounces of silver, or at least it claims to hold 500 million ounces. The custodian, the entity responsible for storing that silver, is JP Morgan. Now, we know from previous reports that JP Morgan has a massive private hoard of 750 million ounces. So, theoretically, they have enough silver to back the SLV. But here's the question. Are they going to use their private hoard to bail out the ETF shareholders? Or are they going to protect their own position? If I'm Jamie Dimon and I have 750 million ounces of silver, and the price is about to go to $150 or $200 because of a global shortage, why would I give that silver away to ETF holders at $80? I wouldn't. I would let the ETF fail. I would let it cash settle. I would pay the shareholders $80 per share and keep the physical metal for myself so I can sell it at $200 to Tesla and Apple in 6 months. This is the cash settlement risk that nobody talks about. The prospectus of SLV, if you read the fine print, gives the custodian the right to settle in cash in the event of a shortage or market disruption. And what we are seeing in Shanghai right now is exactly that, a market disruption. So, if Shanghai is already cash settling 98% of delivery requests, what makes you think SLV won't do the same? What makes you think that when you try to redeem your shares, you won't just get a check for $85 while the physical metal trades at $120? This is why I'm telling you, if you own silver ETFs, you need to seriously consider your exit strategy. Not tomorrow, not next week, this weekend. Because on Monday morning, the Asian markets are going to open with a massive gap up. And by the time New York opens on Monday afternoon, the panic might already be in full swing. If you wait until Tuesday or Wednesday to try to get out, you might find that the redemption window has closed. Now, I'm not telling you to panic sell your ETF shares into a loss, but I am telling you that the risk-reward has fundamentally changed. 2 weeks ago, holding SLV was a reasonable way to get silver exposure. Today, after the Shanghai failure, holding SLV is a gamble that JP Morgan will honor the physical backing. Are you willing to take that gamble? The alternative is to buy physical metal directly. Yes, you will pay a premium. Yes, you will have to deal with storage and security, but you will actually own the asset. You will have the metal in your possession. And in a world where the exchanges are failing to deliver, possession is the only thing that matters. There's another option, which is allocated storage programs like Kinesis or Spratt Physical Silver Trust, which is ticker PSLV. PSLV is different from SLV in a few key ways. First, it's domiciled in Canada, which gives it a different legal structure. Second, it uses the Royal Canadian Mint as its storage facility, which is arguably more secure than a private bank vault. Third, it allows for physical redemption in large quantities, which means you can actually take delivery if you meet the minimum. Is PSLV safer than SLV? Probably. But even PSLV is not immune to the risk of government seizure in a war economy. If the Canadian government decides that silver is a strategic material and implements export controls or requisitions the metal for national defense, your PSLV shares are worthless. This is the sovereign risk that nobody talks about. In a war, the government takes what it needs. And right now, governments need silver. So, the safest option, the only option that gives you full control, is physical metal in your personal possession. Coins, bars stored in a private vault or safe in your home. It's inconvenient, it's expensive, but it's yours. And when the system breaks, yours is the only category that matters. Now, let's talk about the COMEX, because if Shanghai is the first domino, the COMEX is the second domino. And the second domino is teetering. As of the latest data I can find, the COMEX registered silver inventory, the metal that is available for delivery, is approximately 30 million ounces. That sounds like a lot, but let's put it in context. The open interest in COMEX silver futures, the total number of contracts that exist, represents somewhere in the range of 500 million to 700 million ounces of paper claims. That means the paper-to-physical ratio is somewhere between 16 to 1 and 23.1. Now, historically, this hasn't been a problem because most futures contracts are settled in cash or rolled forward. The holders don't actually want the metal. They just want to speculate on the price. So even though there are 20 ounces of paper claims for every 1 ounce of physical metal, the system stays stable because only a small percentage of people actually stand for delivery. But what happens when the psychology shifts? What happens when Shanghai fails to deliver and suddenly every futures holder in the world realizes, oh, I better take delivery now before the metal runs out? You get a delivery squeeze. And in a delivery squeeze, the exchange has two choices. Choice 1, raise the margin requirements to make it prohibitively expensive to hold contracts, which forces people to sell or roll forward. Choice 2, declare force majeure and cash settle all contracts at the last traded price. Both options are catastrophic for the paper market. If they raise margins, it proves that the system is broken and triggers a panic. If they declare force majeure, it proves that the metal doesn't exist and triggers a bigger panic. So, the COMEX is trapped. They can't deliver the metal because they don't have it. They can't admit they don't have it, because that would cause a global loss of confidence. So, they are stuck in a holding pattern, hoping that the demand for physical delivery goes away. But it's not going away. In fact, it's accelerating. The delivery notices for January are going to be released in the next few days, and I am willing to bet that they are significantly higher than usual. Why? Because the smart money saw what happened in Shanghai. They saw the export licensing system go live on January 1st. They saw the premiums in Asia explode, and they said, we better get our metal out of the COMEX vaults now before the door closes. This is the vault drain that we have been tracking for months. The registered inventory has been falling steadily. The eligible inventory, the metal that is stored at the COMEX but not available for delivery, has been stable, which tells you that people are moving metal from eligible to registered and then immediately taking delivery. They are draining the swamp. And when the swamp is empty, the comics will have no choice but to admit that the emperor has no clothes. Now, you might be thinking, but John, you said JP Morgan has 750 million ounces. Couldn't they use that to save the comics? They could, but they won't. Because JP Morgan is not in the business of saving markets. They are in the business of making money. And the most profitable move for them right now is to let the comics fail, let the paper price collapse, and then sell their physical hoard at whatever price the desperate industrial buyers are willing to pay. If the comics declares force majeure and cash settles all contracts at $85, and then JP Morgan turns around and sells their silver to Tesla at $120, they make $35 per ounce profit on 750 million ounces. That's over $26 billion in profit. Why would they give that up to save the exchange? They wouldn't, and they won't. So the timeline for the comics failure is the same as the timeline for the Shanghai failure. It could be days, it could be weeks, but it's not months, it's not years. The system is breaking in real time. This brings us to the question of what you should do right now. Today, Sunday, January 11th. Tomorrow, Monday the 12th, is a market holiday in some regions, but the Asian markets will be open. And Tuesday, January 13th, will be the first full trading day of the week for New York and London. If you own silver ETFs, you have a decision to make. Do you trust that your ETF will honor the physical backing, or do you exit now and buy physical metal while you still can?